So, as of today, August 4, 2026, Strategy is trading at $94.86.
Yeah, which is it's a brutal drop.
It really is. I mean, they are sitting 77.1% below their 52-week high.
Right, which they hit back in August of 2025.
And the main catalyst here, the thing driving this massive negative 76.79% return over the past year, is their Q2 earnings report.
Yeah, that report is, it's something else. They posted a net loss of $8.22 billion.
Billion. With a B.
Exactly. And on top of that, they've actually started selling their Bitcoin at a loss just to cover their obligations.
Which completely shatters the whole narrative, right?
Yeah.
But before we get into the weeds of how a company loses $8 billion in a single quarter, welcome to Market Pulse Daily.
Glad to be here. There is a lot to unpack today.
There really is. And for everyone listening, if you're trying to make sense of crazy market moves like this, we want to mention StockOracle. We've got a special 14-day trial link below in the description.
Yeah, StockOracle is this really great AI-aided stock research platform.
Right. It helps with fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research. Basically everything you need to dig into the numbers.
But, we always have to emphasize StockOracle is not financial advice.
No, absolutely not. It's not a buy or sell recommendation. It's not a trading signal service, and it's not real-time market data.
And remember, AI insights and valuation estimates can be incomplete or just flat out wrong.
Yeah, the data may be delayed, so, always verify important facts yourself.
For sure.
And just full disclosure, that link in the description is an affiliate link, so the channel may earn a commission at no extra cost to you.
All right, so let's get back to that $8.22 billion elephant in the room.
Yeah. I mean, let's look at the fundamental catalysts here. Because Strategy's actual legacy software business is still totally functional, right?
Oh, yeah, completely. They generated $122.4 million in Q2 revenue.
Which isn't bad.
No, not at all. And they have a healthy 67.6% gross margin on that software. They have a real product.
Right. So if the software business brings in $122 million, how is it physically possible to post an $8.22 billion net loss? Like, how do you not just instantly go out of business?
Well, it all comes down to mark-to-market accounting.
Okay, break that down for me.
So that $8 billion loss isn't cash flying out the window to pay vendors. It's almost entirely driven by unrealized losses on their Bitcoin treasury.
Ah, right, because they hold a massive amount of Bitcoin.
Exactly. They hold 843,775 Bitcoin.
That is just a staggering amount.
It is. But here's the problem. They aggressively bought those coins over the years, and their average cost basis is $75,476 per Bitcoin.
And Bitcoin right now is, what, hovering around 63,000?
Yeah, right around there. So their original $63.69 billion investment is now sitting at a market value of roughly $54.77 billion.
Ouch. So that's an $8.9 billion hole.
Right. And under mark-to-market accounting rules, when a company holds an asset like that, they have to report its value at the current market price at the end of the quarter.
So even though they haven't actually sold the majority of that Bitcoin, they're forced to pretend they took the loss on paper today.
Exactly. That impairment flows straight into their income statement as a massive expense.
Which mathematically destroys their profit margin. I'm looking at a reported net margin of negative 6,103%.
Yeah, it's wild.
It's like, imagine a modestly successful neighborhood bakery, right? They make a few $1,000s a month selling bread, but the owner took out $1 billion loan in the bakery's name to buy speculative tech stocks right before a crash.
That's a perfect analogy.
The actual bakery operations mean absolutely nothing at that point.
Right, the core business is completely eclipsed by the investment portfolio. But, and this is crucial, we can't just brush these off as paper losses.
Right, they have real debt, right?
Exactly. The volatility has triggered very real cash flow problems. They didn't buy $63 billion of Bitcoin using profits from selling software.
No way. You can't do that on $122 million in revenue.
Right. They issued massive amounts of debt and preferred stock to the public markets. So today, Strategy faces about $1.76 billion in annual dividend and interest obligations.
Wait, let me just pause there. $1.76 billion a year in obligations.
Yep.
But their core software business only brings in like $500 million a year in total revenue, not profit. just revenue.
That's the cash flow crisis right there.
So they are mathematically insolvent on a cash flow basis.
Essentially, yeah. A huge chunk of that cost is tied to their perpetual preferred stock. Just to give you an idea of how fast this escalated, their preferred stock dividends surged from $49.1 million a year ago to a staggering $400.7 million in Q2 of 2026 alone.
Okay, wait. Perpetual preferred stock. For the listener who might not trade these kinds of instruments, what makes it perpetual? Because normal debt has maturity date, right? You pay interest, then you pay the principal back.
Right. Perpetual means the principal amount technically never comes due. The company never has to pay back the initial cash they raised.
But there's a catch.
A huge catch, the dividend rate. To get investors to buy this, Strategy had to offer a massive 12% yield.
Oh, wow. 12%.
Yeah, and preferred stock sits senior to common stock, meaning they absolutely have to pay that massive recurring cash payout.
So it's like a really high-interest payday loan. You don't have to pay off the balance immediately, but you're trapped paying this huge tax forever just to keep the lights on.
Exactly. And this leads to the most shocking fundamental shift in the company. Strategy has completely paused its regular Bitcoin purchases.
Which was their whole identity. I mean, I thought the entire thesis of this company was to have diamond hands, to accumulate Bitcoin and literally never sell it.
That was the narrative.
Yeah.
But corporate reality just collided with their capital structure. They aren't just pausing purchases, they are actively selling.
Yeah, I'm looking at this now. They sold 5,258 Bitcoin since late May.
And look at the price they sold it at. Their most recent sale of 1,638 Bitcoin was executed at an average price of $63,957.
Wait, but we just said their average cost basis was over 75 grand.
Yep. They sold at a 15.2% discount to their own average purchase price. They are pawning the family jewels at a loss.
Just to pay the mortgage. That is wild. Why would they do that?
Because that $400 million quarterly dividend bill is sitting right there, and the software business can't pay it. When Bitcoin was going up, they could easily issue more debt because the market loved them. But in a downtrend, credit markets tighten up.
So they're forced to cannibalize their own balance sheet.
Exactly. They have to liquidate the very asset they swore never to sell just to service the leverage they used to buy it in the first place.
But mathematically, if you sell your core asset at a 15% loss to pay an operating expense, you're permanently destroying your future upside. Even if Bitcoin goes to 100,000 later, you don't own those coins anymore.
That is the ultimate trap of high-yield leverage in a down market. And clearly, selling Bitcoin at a loss isn't a sustainable way to fund a 12% dividend forever.
So how are they actually surviving right now? Because 5,000 Bitcoin isn't enough to cover everything.
They've built up a massive cash reserve, specifically a $4.0 billion U.S. cash reserve.
Wait, hold on. A $4 billion cash reserve. For a company whose entire brand is based on the idea that fiat currency is a melting ice cube.
I know, the irony is thick.
That goes totally against their philosophy. Why hoard U.S. dollars?
Pure survival. That $4 billion gives them about 2.3 years of runway to cover those dividend and interest obligations.
Yeah.
It takes the immediate threat of default off the table.
But where did they get $4 billion in cash? Not from software and not from selling Bitcoin at a loss?
Nope. It came from the equity markets. Right. They are heavily diluting the common shareholder.
So everyday investors.
Right. The common shareholder is basically acting as the liquidity provider for this whole operation. Look at the week ending August 2nd. Strategy raised a $395.3 million financing pool.
Right.
Common shareholders funded 73.5% of that pool through equity dilution.
Wow. So if you're listening to this and you bought common stock and Strategy recently, your money isn't buying more Bitcoin. Your money is being diverted to pay the 12% yield owed to preferred shareholders.
That's how the capital stack works. Preferred gets paid first. And they have a massive overhang here. Strategy currently has $22.69 billion in remaining common stock issuance capacity.
$22 billion. They can just keep printing new shares to pay the bills. But, I mean, that just inherently crushes the value of every existing share because of the increased supply.
Precisely. Which brings us to the market sentiment. Why is anyone still buying this at these levels?
Yeah. What is the upside argument for holding the stock today?
Well, historically, they had a very specific moat. A few years ago, if you were a retail investor with a standard retirement account, or an institution with strict rules, you couldn't easily buy spot Bitcoin.
Right, there were no ETFs.
Exactly. You bought strategy stock as a proxy. They were essentially an unregulated ETF.
And people paid a massive premium for that corporate wrapper.
They did. But that moat is entirely gone now. We have fully regulated spot ETFs trading everywhere. Big, traditional players like Morgan Stanley are launching highly efficient, low-cost crypto ETFs as we speak.
All right, so as an investor, you have a clear choice. You can buy a spot ETF, pay a tiny management fee, and just get pure Bitcoin price action. Or you can buy a strategy stock,
Where you absorb the risk of a legacy software business. You pay for a 12% preferred dividend, and you get diluted constantly.
It makes the corporate wrapper structure completely redundant.
And yet, it still trades at a price-to-sales ratio of 66.7. The valuation is still incredibly elevated, even though the structural advantage is gone.
But the market is definitely starting to wake up. I mean, we talked about the price action down 77%.
And analyst sentiment is following suit. B. Riley just issued a major price target cut. The whole narrative on Wall Street has shifted from praising their accumulation strategy to just questioning if they can survive their capital structure.
And the insider trading data backs that up too. Over the last 90 days, there have been 98 sell transactions from corporate insiders.
Compared to how many buys?
Only 50 dies. That's a net selling of 163,205 shares by the people inside the building.
That is a terrible look. When the architects of the strategy are quietly dumping shares during a massive drawdown instead of buying the dip, it tells you a lot about their internal confidence.
But there's one fascinating caveat to this. The executive chairman, Michael Saylor,
Right.
he has been very vocal in the media that he has never sold his personal Bitcoin holdings.
He draws a very strict line between his personal wallet and the corporate treasury.
But the optics of that are just brutal. If the captain of the ship refuses to sell his own personal lifeboats, why is he authorizing the sale of the ship's lifeboats? Retail investors bought in because of this diamond hands culture.
It's the difference between personal conviction and fiduciary reality. An individual can hold through a 50% drop because they don't have a 12% perpetual dividend to pay.
Right.
The corporation doesn't have that luxury. The math dictates their actions. They are forced sellers while he gets to be a voluntary holder personally.
It's a tough pill to swallow for the retail crowd who thought they were investing in an ideology. So looking at the pros and cons, is there a path to salvation here? What's the bull case?
We have to look at it impartially. There is a path, but it's narrow. The single most important catalyst, really the only thing that fixes the balance sheet, is the price of Bitcoin going back up.
Above that $75,000 cost basis.
Exactly. If Bitcoin rallies hard, that $8.9 billion unrealized loss turns into a gain. The pressure to sell at a loss vanishes.
And historically, strategy has actually outperformed spot Bitcoin over rolling 4-year periods, right? So if the macro environment gets bullish, that premium could come back.
It could. And internally, management is trying to pull a few levers. Because the market is stressed, those toxic perpetual preferred shares are trading at a discount around $88.42 against a $100 par value.
Oh, so they're buying them back at a discount to retire them.
Right. Using some of that cash reserve to permanently eliminate the 12% dividend attached to those specific shares.
But let's be real about the numbers. The filings show that saves them about $14.4 million annually,
Right.
which is 0.8% of their total $1.76 billion annual obligation. It's a drop in the ocean.
It's mathematically smart, but yeah, in terms of scale, it's like throwing a glass of water on a house fire.
What about the common stock? I see they authorized a massive $1 billion buyback program.
They did, but they haven't used a single cent of it.
Zero. The stock down 77%.
Zero. Which tells you everything about their liquidity priorities. They can't afford to defend the common stock price. They have to hoard cash to avoid a default on the preferred dividends.
Wow. So they are entirely reliant on a macro market save.
Completely. The CEO even said recently that the biggest lesson of 2026 is the vital importance of holding liquid U.S. dollars.
The vanguard of the anti-fiat movement is hoarding dollars to survive. The irony.
It's a deeply defensive posture. You don't hoard $4 billion in fiat if you think a massive crypto rally is happening tomorrow. And if you look at the downside risks, the bear case is scary. Some credible models project Bitcoin could drop back to the $40,000 range.
If it hits 40,000, what happens to strategy?
It becomes a full-blown existential crisis. The paper losses would double, the $4 billion cash reserve would burn much faster, they'd be forced to liquidate way more Bitcoin at massive losses, and the share dilution required to survive would likely wipe out any remaining equity value for common shareholders.
So, to summarize the final outlook and key risks here, strategy is trapped in a capital structure crisis of its own making. They used high-yield leverage to turn a software company into a Bitcoin proxy. Now, with the asset underwater, they have to dilute common shareholders and sell their core asset at a loss just to service the debt.
Their original moat is gone, and their entire survival rests on Bitcoin's price recovering, something they have zero control over.
It's a wild situation. But before we wrap up, a quick reminder to hit subscribe so you don't miss our daily market breakdowns, and definitely check out StockOracle using that 14-day trial link in the description to run these numbers for yourself.
Yeah, but a great tool to have. And leaves you with a final thought to chew on.
Yeah.
If a public company's entire survival, valuation, and capital structure rely purely on the price action of a decentralized asset they don't control,
Oh.
are you really investing in a business anymore? Or are you just buying an incredibly expensive, highly leveraged lottery ticket where the company uses your money to pay the entry fee?
That is the multi-billion-dollar question. When the math turns against you, conviction doesn't pay a 12% dividend. Thanks for joining us on Market Pulse Daily. Keep questioning the numbers, and we'll see you next time.